California's housing market in 2026 is the product of decades of economic expansion, population growth, and geographic limitations that have gradually shaped the state into one of the most expensive in the country. Its sprawling geography, stretching from the Pacific coast to the inland valleys and deserts, offers both opportunity and constraint, influencing where people can build, buy, and live. Coastal cities like San Francisco, Los Angeles, and San Diego have historically attracted residents for employment, culture, and climate, while inland regions have served as more affordable alternatives, though increasingly under pressure as the state's population grows. The roots of today's market lie in California's industrial evolution. In the 20th century, aerospace, entertainment, and agriculture drove regional economies, while universities and research institutions produced talent that fueled innovation. The late 20th and early 21st centuries brought technology and biotech, concentrating wealth and skilled labor in urban centers. As opportunities expanded, so did the population, with millions relocating to the state for jobs and quality of life. Suburban expansion accommodated growth, yet by the late 20th century, regulatory and environmental constraints began to slow construction. Local zoning, environmental protection, and community planning limited available land, creating a long-term imbalance between demand and supply. This structural shortage became particularly evident in areas where high-paying industries attracted skilled workers. Silicon Valley exemplifies this dynamic, with housing demand consistently outpacing supply, pushing prices higher and creating affordability challenges. Los Angeles and San Diego followed similar patterns, with regional differences influenced by local economies, land availability, and cultural significance. The 2008 financial crisis provided one of the few interruptions to California's long-term price growth. Foreclosures and a temporary drop in demand slowed the market, but recovery proved swift as technology and other high-wage sectors expanded. The subsequent decade saw low mortgage rates and intensified competition, further elevating property values. The COVID-19 pandemic introduced short-term uncertainty, prompting some residents to consider relocation, yet the underlying economic strength of the state remained intact. Remote work allowed some internal migration and inland expansion, but urban cores quickly regained stability as offices reopened partially and hybrid arrangements became permanent. By 2026, median home prices remain high relative to national averages, with regional variation shaping affordability. Coastal metropolitan areas command premium prices due to limited land and concentrated economic opportunity, while inland and suburban regions offer comparatively lower-cost options. Inventory remains constrained in many desirable areas, influenced by homeowners holding low-rate mortgages, construction costs, and regulatory hurdles. The market reflects a balance between high demand, limited supply, and rising borrowing costs, producing measured growth rather than sudden fluctuations. For buyers, the reality is a competitive environment that requires strategic planning and financial flexibility. For policymakers, addressing the structural housing shortage requires coordinated approaches that expand supply while preserving environmental quality and community stability. Understanding California's housing in 2026 requires both historical perspective and attention to present dynamics. Decades of development, regulation, and economic concentration have produced a market that is resilient, complex, and unlikely to experience dramatic change without sustained intervention. The state's housing story is thus one of slow, cumulative evolution, shaped by the interplay of opportunity, scarcity, and policy choices that continue to define how and where people can live. By 2026, the measurable realities of California's housing market reveal the combined influence of prices, inventory, and borrowing conditions on residents' daily lives. Median home prices remain high, particularly in coastal metropolitan areas, yet the pace of growth has moderated compared with the early 2020s, when historically low mortgage rates fueled rapid escalation. Rising interest rates have constrained purchasing power, meaning households can afford less than in previous years despite stable nominal prices. This has slowed the velocity of transactions in certain segments, while high-demand neighborhoods continue to experience competition due to limited supply. Inventory remains tight, particularly in urban cores. Many homeowners are reluctant to sell properties financed under lower-rate mortgages, while construction costs remain elevated due to labor shortages, material prices, and regulatory requirements. New development has increased somewhat through multi-family projects, accessory dwelling units, and streamlined permitting, but overall supply still lags behind demand. Regional differences are pronounced. The Bay Area, driven by technology and high-wage industries, maintains some of the nation's highest property values, though growth rates have slowed as remote work allows some workers to relocate inland. Los Angeles reflects a complex mosaic of neighborhoods, where coastal luxury districts remain highly competitive, while inland communities provide more affordable options for first-time buyers. San Diego exhibits steady, moderate growth, balancing desirability with relative stability, while the Central Valley and Inland Empire attract those seeking larger homes at lower costs, supported by improved transportation and hybrid work arrangements. Rentals mirror these trends. Urban cores retain elevated rents, though growth has moderated in recent years. Some neighborhoods experienced temporary declines following early pandemic disruptions but have since stabilized. High-demand rental markets continue to exert pressure on affordability, particularly for lower and middle-income households. Economic conditions reinforce these patterns. High-wage sectors sustain demand in concentrated regions, while areas reliant on agriculture, logistics, or services see slower growth. The uneven distribution of economic opportunity continues to drive regional disparities, influencing both home values and rental costs. Interest rates remain pivotal. Modest changes in borrowing costs influence purchasing decisions and market activity, producing measurable effects across price segments. A slight decline in rates could invigorate competition among buyers, while sustained higher rates may constrain first-time purchasers and slow turnover in limited inventory areas. Construction trends illustrate progress and limitations. Policies promoting higher density housing and accessory dwelling units have increased the supply of available units. Yet expansion is incremental. Local opposition, environmental regulations, and permitting delays still constrain growth, reinforcing the structural imbalance between supply and demand. The cumulative effect is a market that is dynamic but measured. Prices continue to reflect high demand and limited supply, while the pace of transactions moderates in response to borrowing conditions and affordability constraints. Buyers and renters must navigate a competitive environment with careful planning, while sellers benefit from a resilient market that maintains elevated values despite moderate growth. Understanding California's housing in 2026 requires attention to both macroeconomic forces and local conditions. Coastal regions demonstrate the persistent influence of concentrated opportunity and limited developable land. Inland regions illustrate the gradual redistribution of demand enabled by transportation and hybrid work. And construction and policy decisions shape the available supply that ultimately determines affordability. This interplay of factors produces a market that is neither volatile nor stagnant, characterized instead by a delicate balance between high demand, constrained supply, and evolving economic and social dynamics, setting the stage for continued adaptation in the years to come. Migration patterns continue to shape California's housing market in 2026, reflecting a long history of population redistribution both within the state and beyond. Outmigration to lower-cost states such as Texas, Arizona, and Nevada has been notable, particularly among higher-income households seeking more space or lower taxes, yet inflows from other U.S. regions and international immigration balance these departures. Internal migration within California is increasingly significant, with residents relocating from high-cost coastal cities to inland suburbs, smaller cities, and regions with more affordable housing options. The expansion of remote and hybrid work has reinforced these trends, allowing households to prioritize space, cost, and quality of life over strict proximity to employment centers. economic concentration continues to dictate where housing pressure is most acute. Technology, biotechnology, entertainment, and advanced manufacturing sectors create high-wage clusters in specific regions, sustaining demand for nearby housing. Coastal cities with limited developable land remain the most expensive, while inland areas gradually absorb displaced demand, producing a more dispersed but steadily rising pressure on prices. Policy developments influence both supply and distribution of housing. Recent zoning reforms permit higher density construction, including multi-family units and accessory dwelling units, while state-level incentives encourage faster permitting and affordable housing inclusion. Despite these efforts, local opposition, environmental regulations, and municipal discretion continue to moderate expansion. Community concerns about infrastructure, school capacity, and neighborhood character shape where and how housing can grow, demonstrating the delicate balance between regulation, development, and demand. Infrastructure and transportation are equally critical. Expansion of highways, rail networks, and public transit affects where housing is feasible, linking residential areas to employment centers and shaping migration patterns. Inland regions with improved connectivity experience faster population growth, while areas without robust transit remain more constrained, maintaining higher prices in already desirable locations. Environmental and climate considerations add further complexity. Wildfire risk, water scarcity, and other natural hazards influence construction decisions, insurance availability, and long-term affordability. Policies promoting sustainable development encourage denser, transit-oriented housing near existing infrastructure, reflecting the intersection of growth and environmental stewardship. For residents, these structural forces manifest as observable market conditions: pricing, rental costs, inventory availability, and neighborhood desirability. Buyers and renters respond to them pragmatically, while policymakers and developers work within constraints to expand supply and manage demand. Economic diversification offers some resilience as industries expand beyond traditional coastal hubs. Growth in renewable energy, logistics, and biotechnology disperses employment opportunities, contributing to incremental housing demand in multiple regions and reducing absolute concentration in a few urban centers. California's housing market in 2026 is therefore defined by the interplay of migration, policy, infrastructure, and environmental factors. Supply remains limited relative to demand, regional disparities persist, and affordability challenges endure, yet incremental shifts indicate gradual redistribution of population and moderated pressure in some areas. The market is dynamic but measured, shaped by decades of structural trends that continue to influence prices, availability, and location choices. Understanding the current state requires attention not only to short-term fluctuations, but also to long-term forces that operate quietly yet powerfully, ensuring that the housing market reflects the cumulative effect of historical growth, economic concentration, policy intervention, and demographic change. These patterns suggest that while affordability pressures will persist, gradual adaptation, through internal migration, regulatory reform, infrastructure expansion, and economic diversification, can reshape the market over time, offering new opportunities for both residents and policymakers to navigate the state's complex housing landscape. Looking forward from 2026, California's housing market is entering a phase shaped by the cumulative effects of past trends, policy decisions, and emerging economic realities. Supply remains a central constraint, and while reforms promoting multifamily construction, accessory dwelling units, and streamlined permitting have increased housing availability incrementally, growth is unlikely to fully match demand in the near term. Coastal metropolitan areas will continue to see high property values, reflecting concentrated economic opportunity, limited developable land, and enduring desirability. Inland regions, including the Central Valley and Inland Empire, will gradually absorb displaced demand from the coast, providing somewhat more accessible housing, but experiencing rising prices as interest and population pressure mount. Interest rates will remain a critical factor in determining both affordability and transaction velocity. Even small fluctuations can alter purchasing power, affecting who can enter the market and which segments experience the most competition. Stable or slightly declining rates may encourage first-time buyers to re-enter, while sustained high rates could constrain affordability and slow turnover. Particularly in already expensive neighborhoods, migration patterns will continue to shape regional dynamics. Outmigration to lower-cost states persists, yet inflows from other regions of the U.S. and international arrivals offset departures, maintaining California's population growth and housing demand. Within the state, hybrid and remote work arrangements enable households to relocate to inland or suburban areas while retaining access to employment centers, gradually redistributing demand and affecting local economies, schools, and infrastructure needs. Policy implementation will be decisive. The ability of local governments to approve higher-density developments, balance community concerns, and coordinate with state incentives will determine the pace of supply growth. Environmental regulations, community standards, and infrastructure capacity remain important constraints, requiring careful planning to avoid overextension while expanding housing availability. Climate and environmental risks, including wildfires, water scarcity, and earthquake considerations, will continue influencing where development is feasible and how costly construction becomes. Sustainable planning policies favor denser, transit-oriented developments near existing infrastructure, aligning housing expansion with environmental stewardship. Economic diversification across the state offers resilience. Growth in sectors such as renewable energy, logistics, biotechnology, and advanced manufacturing disperses employment opportunities beyond coastal urban hubs, gradually broadening housing demand geographically. This trend may moderate pressure in highly concentrated regions, but will not eliminate affordability challenges, as overall demand continues to exceed supply. For residents, these forces translate into measurable outcomes: high prices in coastal cities, incremental increases in inland areas, competitive rental markets, and constrained inventory in desirable locations. Buyers, renters, and investors must navigate these conditions strategically, considering location, financing, and timing, while developers and policymakers coordinate to expand supply without compromising community standards or environmental goals. The market is neither volatile nor static. It evolves gradually, shaped by long-term structural factors and policy interventions. While affordability pressures persist, incremental adaptation through zoning reform, infrastructure expansion, migration, and economic diversification offers opportunities for moderate relief. California's housing in 2026, viewed in the context of history and structural dynamics, reflects a complex equilibrium. Demand remains high, supply is constrained, and regional differences persist, yet the market adapts in measured ways. Understanding these trends provides insight into the state's housing trajectory toward 2030, emphasizing that meaningful change is likely to be incremental, regionally varied, and dependent on coordinated efforts across economic, policy, and environmental domains. The story of California housing is therefore one of slow, cumulative evolution, where opportunity, scarcity, and policy intersect to shape the decisions of residents, the strategies of developers, and the outcomes of a market that remains resilient, dynamic, and deeply connected to the state's history, economy, and geography.